All right, everybody. So we're going to get started. This is chapter 11 in the textbook, and it's going over financial markets. Think of this as a basic crash course into a couple of investment type of opportunities, weighing the risks of those different opportunities. And then what you're looking at even here right now, which is the New York Stock Exchange, this is a perfect example of a financial market. So we're going to talk about what that means as well, and then even the different individuals on the floor of that stock exchange too. So first and foremost, what is an investment? Well, ultimately what you're doing is you're taking resources that you have right now that could be consumed today. So I put the cash here, so just money, currency, and then ultimately you're going to invest that money. You're going to redirect it into something like property, like the home here. And so ultimately, you're basically trying to put in money now for the sake of it being worth more money in the future. And based on how much time it waits and weighing the risk of the actual investment, you could actually make a lot of different money. And in the tax world, you call that capital gains. And we'll get into that as well. So ultimately, when you talk about more from a macro scale, but within an actual economy, you really want something like investment, and this is why the free market is oftentimes seen in very developed nations, is because when people invest, there promotes this economic growth, and so this is why you're supposed to actually spend your tax return, and this is the purpose behind something like UBI. So once you get that $1,200, you're going to want to spend it because ultimately that investment in the economy in this regard can spur the economy. Unfortunately, when we look at a lot of different investments, this may not improve the economy. Oftentimes, people will save it or they'll invest it in something that may not ultimately benefit the economy now. And when you're looking at an investment, you do need the physical piece of paper. So when we discuss in economics the concept of financial asset, what that means is it's the actual document itself. So this, obviously very pixelated, is an example of what you call a pink slip. So this is proof that you own your automobile. So it's certificate of title. This is your financial asset. Yes, the actual automobile itself, but this is your proof that you actually own that automobile. And so basically, what we look at with financial assets is in a mixed economy and a market economy, ultimately, you have the ability to exchange these different financial assets. And so when you talk about a financial system, if you are a saver, okay, so you have money right now and you saving it, you can invest it with the financial system. So you can put it into stocks or bonds. And then ultimately, when you talk about like a borrower, so if you go to a bank and you want to open up a business, you can get a loan for that. If you want to go to school but you can't afford it right now, you can get a loan for that. And so financial system is where you have all these people borrowing money, such from banks and lenders, say the federal government with student loans, and then ultimately people will be able to save their money in things like banks as well. So when you talk about stocks, and so this is a specific type of investment that you can make, and ultimately what a stock is, or another way to talk about it is a share. So you own a percentage of that company. So if you take the example of, let's say we're going to divide Boeing into 100 shares, if you buy one share of Boeing in this scenario, you own 1% of the company. And so not all companies are bought and sold on the stock exchange or a specific stock exchange, but some could be like Trader Joe's. They're not a private or a public company; they're private. And these down here, Boeing, IBM, Coca-Cola, these are examples of stocks, and these are even what you could call blue chip stocks, ones that are have been around a while, are known to be a sound investment, things like that. Now, when you talk about the actual market itself, and so this could be the market cap of the New York Stock Exchange. So, slang term market cap, also known as market capitalization, but that's the total value in the actual market. And so, when you talk about Coca-Cola, what is Coca-Cola's market cap? Well, that's the total value of all the stocks being bought and sold. Same thing with Boeing. The market cap of Boeing is the total value of Boeing if you add up the value of all the stocks. And obviously, the market cap will change, but it's a good indicating factor of if you should invest into a company, just one, but a way to kind of look at their value. Now, ultimately, as a stock owner, you can make profit in a couple of different ways. The most obvious way is if you buy a stock that gives a dividend. So, a dividend is every quarter. So, every 3 months, a company will report their earnings for that quarter. And then, based on how the company's stock is set up, they can ultimately give a percentage of their profits to their stockholders in the form of a dividend. So it's really a cash payment. What I do with my stocks that have dividends is I just reinvest it into more shares of other stocks. My grandmother, who lives off her dividends, she deposits that cash into her checking account, and then that's what she uses as part of her income. Now, there's the other type of ways that you can make money as a stock owner is when you ultimately sell your stock, and this is the most obvious way to make money. You buy something at $100, you sell it for $110, you make $10. That's the capital gain. On the other side of this, ultimately understand that you can suffer a capital loss, and this happens a lot, and this is what a lot of people are struggling from with the market going way down. And so ultimately, yes, you can make money as a stock owner, but say with a dividend, if a company doesn't make money during that quarter, you're not going to get anything for a dividend that quarter. And if a company is losing value or the stock market is going down, so like Boeing, for example, unless they start making something else, there's not going to be a whole lot of demand for planes because every plane is basically grounded for the most part. So just a couple of ways that you can make money. Now, when you talk about the types of stocks, not all stocks give dividends. And so the types of stocks that do give dividends, you call them income stocks. And ultimately, that you call them income stocks. Think of my grandmother who lives off the dividends from her stock. That is part of her income. And then the other type of stock, this is probably more common, is that stocks do not give a dividend. And so when you talk about these, you call them growth stocks. And so basically, with an income stock, take something like Apple. Apple gives a dividend. So anytime they have profit, they give it to their stockholders in hopes that they'll buy more stock. That's one way to do it. Growth stock is a company like Tesla, which any profit they do make, they reinvest in their own company, which makes the stocks more valuable. Both are attempts to make the company's stock more valuable, but the way they do it is a little bit different. And then you also talk about when you work for a company or when you own a corporation, and we'll talk about buyback stocks later. But essentially, when you talk about an investor, and this is usually someone who is on the board or they are hired and given stock privileges. These are very specific stocks, and I understand it's kind of a misnomer, but the investors who buy common stocks, they get the voting ownership. And then if you have preferred stock, this is just what most people have. So when I say that I own stock, I own preferred stock. I don't get a vote. I don't have any decision making within the company itself. You would say that someone who has decision making ability has common stock. And ultimately, this is how you would say that a company can decide how they would like to go public, as it were. And so once they're traded on the open market, this is how they are classified. And so as a stockbroker would help, they ultimately would help people to invest in different stocks and give advice as to which ones that would be the best investment opportunities. Now, oftentimes what we see with stocks is when they get super valuable, they'll go through what's called a stock split. And basically this happens, so you take Apple, take Google, take Amazon. These are all companies who have gone through stock splits. And ultimately you take, if you own one share for $500, if there's a stock split, now you're going to own two shares for $250. And so why ultimately would a company do this? Well, they're trying to get more people to invest. And if the price goes up super high, people are going to look at that and they're going to balk and they're going to say, that's too much money. I don't want to invest in that. Whereas if you do a stock split, it looks like it's half the price, and so ultimately more people will kind of run to invest, even though technically the stock is less valuable. So I think I've gone through maybe two stock splits with my Apple stock. And so technically, even though I haven't bought additional Apple stock, I own more than double the Apple stock I started with. But that's because of stock splits. Ultimately, I didn't do anything. So understand that with buying stocks, yes, you can make a lot of money and people do it professionally, but it is a risky investment. And I don't expect you to be writing all of this bullet point down. I put a lot of information on these slides on purpose in case you guys want to go back and kind of check it out. So relative risk here. So you say that a stock is much more risky than putting money in a savings account. It's more risky than a bond, but maybe, yeah, and we'll talk about different bonds as well. But in general, stock is potentially risky, and so this is kind of what we're seeing right now is moving into a bear market after basically almost a decade of a bull market. We're seeing the risk of buying stocks potentially, and then you can have a run on the stocks where you see so many people selling, it causes more people to sell, and it's kind of a snowball effect. Okay, so kind of the actors involved in the stocks themselves. Now, the picture at the bottom is an example of someone who is a stockbroker, and this is someone who would buy and sell the stocks. And so you would say that a stockbroker works for a brokerage firm, and although the stocks are, really just numbers and information data on a computer screen, think of it almost like a stockbroker with a couple of their friends open up a brokerage firm, and they just have a giant warehouse of stocks that they bought on the New York Stock Exchange, and they're just going to hold on to them, and they're going to make it so even though you need a license to buy and sell on the New York Stock Exchange, well, they bought it for you, and they're going to link you to it, and they're going to help you access it. And so ultimately, their job is to buy stocks and be able to get you to buy stocks. And ultimately, the way they make money is you pay a fee for their services, right? And ultimately, with someone buying and selling stock, it is bought and sold on the New York Stock Exchange and the NASDAQ and things like that. But ultimately, most people are buying stock from stockbrokers. So stockbrokers are kind of a middleman type of thing, but understand you do need a license to be on the actual floor itself. So let's look at these. So if you are a stockbroker, you work for a brokerage firm, your job is to buy and sell stocks on what's called a stock exchange. So this is a perfect example of a financial market. This is where you can turn borrowers into sellers. And so the New York Stock Exchange, this is the United States' largest, and ultimately only the most established companies, Fortune 500 companies, are going to be sold on here, and usually companies that have been around a long time. So Coca-Cola is traded on the New York Stock Exchange, and so if you're going to open your IPO on this stock exchange, it's a big deal. And that ultimately can inform investors as well as kind of looking at where it is actually traded. I believe that Shanghai is top three, and in London Stock Exchange as well. But in the United States, this is the largest. However, a lot of growth has been seen with what's called the NASDAQ, Amex. And so this is really with tech stocks. So things like Facebook are sold on the NASDAQ, Uber, Lyft, a lot of different social media, a lot of Silicon Valley type investment type things. So the NASDAQ, you do see a lot more sold really since the year 2000, obviously because of the dot-com type of explosion here. And really just kind of bringing it in really from the late 90s and going forward, you see more and more stocks being sold on the NASDAQ, but it wouldn't be uncommon for a company that perhaps started on the NASDAQ as a small company and then grew and to go onto the New York Stock Exchange. And that would show the establishment component of this as well. Another example is the OTC, over-the-counter market, and really what this is you can go on to different websites and you can buy and sell stocks and basically they're not organized by an exchange, and this really is a lot of like accessibility. You're basically democratizing the stocks and allowing people to get involved without having to go through a stockbroker, essentially. And then the other thing that we see, and this is actually a specific vocation within the stocks and financial type of occupations, is you can become a day trader. Now, when we do our stock market game, this is ultimately what you guys are going to be doing too, is day trading. And so day traders like this guy down at the left corner is basically trying to make money minute by minute. And so the type of exchanges that you would make as a day trader might be very different than those that you're trying to save for a while. So I don't really plan on selling my Apple stock or Google stock. I'm really holding on to that until retirement. Whereas a day trader is going to sell them within minutes or within hours, and ultimately you're going to just end the day with more money than you started with, and that's the goal. Very, very stressful. So, a couple of ways you can invest in different stocks. Now, we talked about the different kinds of stocks as investment opportunities. Now, when you actually put that money onto the market, there's actually, we're going to talk about two ways in which you can make a capital gain, in which you can make a profit. The most common is the long position. Now, don't overthink this. You buy a stock at $10, you sell it at $15, you make $5. That's what you call a long position. You are banking, quote unquote. You are hoping that that company will make money. You're hoping that that company will do well. And if it does well, you make money. This is how most people invest their stocks. Now, a kind of complicated way, and I'll dive into it as an example, but understand that you can also do what's called a short position. Now, if you've seen The Big Short, this is kind of the premise of the movie here. But a short position is basically you invest in a company, and when the company loses money, you make money. Now, a lot of people look negatively upon short selling because you are banking on a company doing poorly. And so, for example, there's kind of an unethical look at people now in this kind of economy, this market, where it's going down and they're going to continue to buy because they expect that it's going to continue to fall. And then they will make money. Now, when you talk about a short position, this is also when you talk about the 2007 height of the housing market. Part of why the housing market did so well is because basically banks were shorting mortgages. They were giving what are called subprime mortgages, and they knew that the people couldn't pay them back. And ultimately, when the people didn't pay them back, the bank made money. And so basically short positions is a way to make money. I'm going to show you this on the stock market game too, but can be somewhat of a negative kind of appeal here. Now let's talk about what this is, because the fact that you would invest in a company and it loses money, you make money, that's really bizarre and is kind of a complicated type of thing. So I'm going to break it down with Seth here, and understand that at the end of the day, as long as you can comprehend that you're investing, if the company does poorly, you make money. That's what you need to understand about a short position. But if you are curious, this is an example to kind of break it down. Okay, so Seth wants to buy Netflix, and ultimately Netflix is $50 a share. But Seth really thinks that Netflix is going to go down. Maybe it'll go down to $40 a share. It'll go down to $30 a share because ultimately it's overvalued. There's a bubble right now, and so Seth wants to make money on this because he has the ability to invest money and he thinks that Netflix is going to lose. So what he's going to do is he's going to go to his stockbroker. And his stockbroker is going to say, "Hey, Seth, how's it going?" And Seth's going to say, I really would like to make money on the fact that I think Netflix is overvalued. So the stockbroker says, "Great, Seth. Here, let's go to our, virtual warehouse of stocks. I got an extra couple Netflix stocks on hand. So here, why don't you borrow this from me, and then you can give it back to me later." Okay, so Seth is basically going to borrow one share of Netflix stock that the stockbroker had previously bought. And then when he has this stock, he's going to go ahead and then he's going to talk to his broker and say, "Look, I'll take this and I'm going to sell it, and then I'll give you interest." And so The reason the stockbroker is willing to have Seth do this is ultimately because he's going to pay interest. And so it's kind of like a fee, a rental fee for allowing Seth to borrow the stock and sell it on his own. So now Seth is holding on to a piece of Netflix stock that he's borrowing from his broker. And so what Seth is going to do is he's going to sell it on the New York Stock Exchange for $50. So someone on the New York Stock Exchange borrows it for $50. And so this basically opens the short position. And so because he sold it on the New York Stock Exchange for $50, he's going to wait, and when it's worth less money, he's going to buy it back at the less dollar amount. And so he's going to wait a month. Now, after a month, Netflix is worth $30, okay? So because it's worth $30, he's going to buy it back. He sold it for $50, and then he's going to buy it back because remember, he has to return a share of Netflix back to his stockbroker. The stockbroker doesn't care what the value of the stock is. He just wants one share. He just wants one stock. And so when Netflix drops to 30, he buys it at 30, and basically then he's able to give it back to his stockbroker for $30, and now the stockbroker is happy because he has Netflix stock. He doesn't care how much the value is. And ultimately, because Seth sold it, and he bought it back at $30, he makes $20 because he thought it would go down. He borrowed the stock to make money, and ultimately, after he pays the interest rate to his stockbroker, then he's good to go. Now, let's break this down. Say it a different way. Seth is overvaluing Netflix, or he believes it's overvalued. So he's going to borrow one share of Netflix and sell it on the market for $50. Then when it drops to 30, he's going to buy it back on the market. So he went to the market and sold it for 50. He's going to buy it back for 30. He's going to give that share back to his stockbroker. All the stockbroker wanted was an interest rate for borrowing however long it took him to keep it, and ultimately Seth makes $20. Now, this will make much more sense once we do it on the stock market game, and I do apologize if this made it worse, but let's keep going. Now, a couple of other terms, because what we're looking at is how do you know how you want to invest your money? Now, you know you want a growth stock or you want a dividend, so you're going to invest in an income stock. Now, which stocks do you know how to invest in? Well, you could take a long position on stocks you believe in. You could do a short position on stocks you feel are overvalued. But what actually helps you be an informed investor? Well, some things we look at are things like the price to earnings ratio, the P to E ratio. Now, the actual definition is that it's whatever $1 that's invested in order to receive $1 of that company's earnings. In short, what you need to understand is not even the actual textbook definition of this, but really this is an example of a valuation metric, a way for us to see what is the value of a specific company based on their potential earnings. And so when we look at this, we want to look at two types of P to E ratio. So there's a historic, the trailing 12-month, the TTM P to E ratio, and this basically looks at, okay, based on the investments, the buying and selling of stocks, and the value of this company in the last 12 months, what does that look like as far as their earnings? So if I were to invest $1 in, how much would their earnings have to be to get money back? Now, you can look at this in the past, as I said, the TTM. You can also look at a forward P to E ratio, which is a projection on how it's going to be in the future. And so basically what you want to look at is you want a higher P to E ratio, and you can't ultimately just have one number. You have to use these as comparisons. So let's look at an example. So this is just a graphic showing, and so if you look at something like Amazon, okay, Amazon has a P to E ratio, a forward P to E ratio of 1158. And if you compare this to Facebook, which has a P to E ratio of 64, I mean, clearly Amazon's is through the roof. And so what does this demonstrate when we compare each of these P to E ratios is Amazon's going to grow. Facebook is not expected to grow, and relatively, Google is expected to grow more than Facebook, but less than Amazon. And so, this is a way, if you're looking forward, how much is this company expected to make money in the future? Is this an investment that I should be looking at? And if you're unsure about the future growth, let's take the past P/E ratio and use this as an indicating factor of whether or not to invest. And so what we're looking at here is the P/E ratio is a way for you to evaluate how valuable is this stock? How much is this stock going to grow? Is this a better opportunity than the next opportunity? And this is where the comparison comes in. Couple of examples. So if you go to Google Finance, you can actually see a lot of these different metrics. And so just looking at this, okay, so this is Apple, and this is from last year. I didn't want to necessarily show what things are looking at right now just because it's so volatile. But as of last year, okay, a couple terms we went over. You can see the market cap. Okay, so the total value of all Apple stocks is $745 billion. And you can see the P/E ratio. In this case, it's the projected, the future P/E ratio. Well, this P/E ratio compared to something like Amazon is much, much less. But ultimately, seeing the P/E ratio here doesn't really help us. It only would help us if we're going to look at it from another company's perspective as well. Now you can also see a couple of other things. Now this is showing just one day, and you can see how it changes over the course of the day. You can see the previous close, and you can see it over the course of a lot of different time frames. And ultimately, when you look at the open, the high, the low, this is based on that day of trading or the 5 days or the 1 month. But Google Finance is great as far as showing this, and it even shows the ranges here to help you be a more informed investor. Great. So then a couple of other terms as far as relating to stocks is really when you talk about two different markets, you talk about a bull market and a bear market. And up here is actually, this is in New York. This is at the New York Stock Exchange, the bear market, or the bull market here. And it's basically trying to show over time there's a steady increase in stocks. And this really is, when you look at the bull, you could say the horns charge up, right? And so a steady rise in stocks is from charging up. Whereas conversely, you have a bear market, and the bears, their paws, their claws slash down. So you would say from 2000, maybe 2016 to the present, we've had what's called a bull market, where you have quarters strung together with quarters of growth. So it's growth, and then next quarter growth, and then the next quarter even more growth. That's a bull market. Whereas when you have two quarters together that demonstrate a downturn in the market, you call this a bear market. In bull markets, more people invest, more people are spending their money. In bear markets, people are saving their money, people are selling stocks, things like that. So how do we know how well a stock is doing? Well, bear and bull markets are more just kind of slang terms of the industry. But when you talk about it specifically, there are actual companies whose jobs it is to basically take the temperature of the stock market itself. So the Dow Jones Industrial Average is not a stock exchange. It's a stock index, which means it's telling you how well they think the stock market is doing. And the way the Dow Jones does that is they look at 30 specific companies, very, very high performing companies, very specifically chosen through their own rigorous process. And basically, they're going to take that as a general idea of what the market will be based on looking at 30 very specific companies. And then another example is Standard & Poor 500. So the S&P 500 is another way to look at this. Again, taking a temperature of the market. And so similar idea, but different way they do it. And the S&P does it by looking at 500 different stocks. And these are very high performing companies as well, but just a different way of looking at it. So if we look at the S&P and the Dow Jones today, when people say, look at the Dow Jones, how low it is, this is what they're talking about, is it's kind of demonstrating the rest of how the market might be based on looking at those 30 companies, and then S&P looks at 500 companies. So, a couple of other ideas, not stocks, but investment opportunities or in ways to kind of save your money. You look at these concepts of financial intermediaries, and these are things like banks, and ultimately they're institutions that help channel funds from savers to borrowers. And so you can take your money and you can lend it out, and ultimately you can take parts out of your paycheck and you can invest it in the market. And then when you retire, you'll get that money. That's called a 401k. And so, a couple of examples. When you put your money under your mattress, like my grandparents have done because they grew up during the Great Depression, if something happens to the house, you're out of luck and that money is gone. But if you put it in a bank, there's something called the FDIC, which insures that money. So if anything happens to the bank, you will get your money back. And so a bank is an example of a financial intermediary. And basically, how banks work is everyone pools their money into the bank and then the bank loans it out to people. So if you have $500,000 in the bank and you go up to the teller and you say, I would like to withdraw all their money, likely they're going to say, sorry sir, we don't have that money, we don't have that cash. And that's because banks loan it out to other people. When you talk about the difference between a bank and a credit union, a bank is usually much larger. There's a larger share of money being shared, whereas a credit union, usually there's a specific requirement to be a part of that credit union, and so it's less people sharing money. So I, for example, belong to a teachers credit union, there's a firefighters credit union, there's that Navy federal credit union, and basically it's just a more specific way of having your money shared, and there are different benefits to that as well. Now, another way you can invest your money is in what's called a mutual fund. I would highly recommend for all of you to invest in mutual funds as you go into college, and then maybe even something investing in it as you go into college, and then take it out after you're done with college, and then maybe you go on a trip or something like that. My wife and I used a mutual fund when we were saving money for our wedding. It's a very effective way and pretty minimal risk as far as investing your money. So a mutual fund is looking at ways to invest and saying, you know what, stocks are kind of risky, but bonds are less risky. And, let's put some cash in there too. So you basically take a couple of stocks, you take some bonds, you take some cash, and you put it all together with several other people, and basically that's going to make money. That's going to show a capital gain, and because you're pairing it with bonds and cash, it's not as risky if the stocks do poorly, or if a bond defaults, perhaps the stocks are doing well, and so you're not putting all your eggs in one basket, as it were. And a mutual fund is really a pretty safe way to do this. You can do it over a year, which is not advised, but maybe 5 or 10 years is a great way to do this. And then also, when you talk about something like life insurance works as you pay in a bunch of money each month as a premium, and then if you pass away, then that money is paid to your family, and ultimately that's the intermediary, is people are paying in to the insurance company, so the insurance company has lots of cash, and ultimately that cash is used to pay out to different families when they actually pass away. The rate of paying in, it far surpasses the rate of paying out, and that's how life insurance companies are able to stay afloat. A last type of financial intermediary and a way to kind of invest money is with what's called a pension fund. And basically, this is set up by the employer and the employee. And so, if you take the store owner, each paycheck, they're going to put in a little bit of money into a pension fund, and then you as the employee are going to put a little bit of your paycheck into the pension fund. And usually this will be seen in what's called a 401k, and basically that money that you're putting in from your paycheck and your boss is putting in from their profit margin, they're going to put that money into some investments, usually with some bonds and a lot of stocks, and you're going to make money, and then hopefully by the time you retire, that 401k is going to be worth enough that you can retire on that amount of money. So when you talk about risk and return, and this is something we've generally talked about. Now, if you talk about a high risk, okay, this would be a lot of different stocks, maybe not a whole lot of bonds. Whereas low risk is perhaps you're only doing a couple of bonds, maybe a mutual fund. And so ultimately what you talk about is this term liquidity. Now, savings accounts have what's called great liquidity, because if you want to turn your savings account into cash, you go to the bank and you say, hey, I want my cash. Whereas something like a house, yeah, it's worth a lot of money, but the ability to turn that into cash very quickly would take a bit of time. You're going to need a realtor. You're going to need someone to buy the house. You're going to need to go through escrow and follow all these different steps. So when you talk about something that is high liquidity, so easily converted into cash, usually not a high rate of return. Whereas something like a home, which is not super liquid, that's going to have a higher return. So ultimately, to say things a different way, if you invest in an internet company with your friends, you could double your money. Or you invest in their app startup because they're really good at coding, you could make a lot of money, but their company could also fail. And so this is the high risk, high reward, low risk, low reward. If you put your money in a savings account, it's a pretty low risk. And so you're going to get maybe a couple pennies if you keep it in there as sort of a thanks for keeping it in the bank. Whereas if you put money in a stock and the company does really well, you can make a ton of money, but that company could also do poorly. And so it's weighing both of these. And so for those of you that are wanting to get into investing, I would highly recommend investing in multiple things. So getting invested in a couple stocks, getting invested in a couple bonds, getting invested in some mutual funds and things like that. And we'll talk about things like Roth IRA and other retirement types of things later as well. Awesome. So one last kind of component with these is we've talked about the different financial intermediaries. We talked about ways you can invest your money in stocks. And ultimately, you can invest your money in bonds as well. And think of bonds basically as loans, as IOUs. And oftentimes we think of bonds with like war bonds. So during World War II, the US government sold bonds. And basically, what that means is you're going to give the government cash so they can use that to fight the war. And then the government's going to pay you back after the war is done. And they're going to give you some interest as a thank you for giving us the cash when we needed it during the war. So let's look at bonds with their specific components, and this is at the crux of what you need to understand, is there's this coupon rate, and so this is why you would want to purchase the bond. This is what you're getting out of it. If the bond is $100 and the interest rate is 10%, well, once you get that bond to maturity, you're going to get your $100 back and an extra 10% on that. So let's actually put these terms together. So actually starting at the bottom, so it says the par value, the amount that an investor pays to purchase the bond, and that will be repaid to the investor at maturity. And so the par value, so if you're going to want to purchase a bond and it's $100, the par value of that bond is $100. And if it says that the par value will be reached in 5 years, well, that's what the maturity is. So you would say the par value of $100 for a savings bond will reach maturity in 5 years. So that means that you're going to pay $100 for the bond right now, but if you get stuck on tough times and you need to buy that bond back in 3 years, too bad. It's not going to be ready yet. So you're basically giving up cash now so you can make money in 5 years. So grandma buys you a savings bond for $100. Grandma bought it at $100. It'll reach maturity in 5 years, and ultimately you're going to be paid a coupon rate of 2%. So you're going to get a little extra as a thank you from the bond issuer for investing in the money. So take the World War II example. The par value of a war bond is $100. It'll reach maturity at the end of the war, let's say 10 years. And that would be the maturity is 10 years. Then the government is issuing a coupon rate of 5%. So you will be paid back $100 plus an extra 5% as a thank you from the government for investing. Now, when we talk about these, not all of these will be held at maturity. And ultimately, when you talk about a bond's yield, they can change. When you talk about ratings of bonds, they can be altered within that 10 years, within that 5 years. But ultimately, what you need to understand from this unit are these three basic components. What you purchase the bond at, the par value, that's not going to change. After you purchase it, it's been purchased. Now, the maturity, it could be bought and sold before that. It's not going to be worth as much. And one thing that can change is the coupon rate. So some examples. Savings bond are the most common, and usually they're lower denominations, so less than $10,000. And usually these are issued by the U.S. government. You can purchase savings bond from the U.S. government, and usually, these take a long time. Now, when you talk about, so it says $100 bond costs $50 to buy. So what that means is basically your par value is $50. Um, and eventually it'll be worth $100. And so the $100 eventually will show with the interest. And but you only get that interest when the bond is fully formed. Treasury bonds, these are just bonds given by the U.S. government from the specific treasury, and these are things that you can buy now. They're probably rated a little bit lower, so there's probably a higher rate of return of investment. And then you look at something like a municipal bond. Now, this is what we're seeing more of today when people are wanting to help spur the economy. You can purchase a municipal bond, which can help pay for improvements, usually infrastructure improvements. But with something like the coronavirus, this could be something that can help too. Is you can basically, this could be a way to donate to hospitals in a way that you would also have a return because you're not expecting the money now. Take the money now to help the hospitals and then pay me back later type of idea. Corporations can also do this as well. And so Netflix is notorious for selling what are called junk bonds. And those are very low rated bonds, meaning that if you get paid back, you're going to get a lot of money, but it may not even be possible that you get paid back your own amount of money. So we'll talk about the risk of bonds here. And yeah, so junk bonds, very high risk, very high reward, but ultimately it's more likely that things won't do well. Now, a couple of pictures I put at the bottom. So this right here, Series EE, this is a treasury bond. So you purchase that from the U.S. government. This is a corporate bond, the Ford Motor Company. Okay, so you're giving money to the Ford Motor Company so they can use it, and then they'll pay you back with interest. And then here's one from the county of San Francisco, so a municipal bond. And so again, think of these like loans. You are giving the government money. You are giving the Ford Motor Company money, and in return, in a couple of years, they'll pay it back to you, and you'll make a bit of money on that too. So looking at bond ratings, how do we know how much how risky an investment is for a specific bond? So there's two that look on here, and I'll get to those in just a moment actually. But if you look at a AAA rated bond by Moody's, basically what this means is it's really a high quality investment. If you invest $100, you will basically be guaranteed to get your money back. Whereas something like a C rank junk bond, like something that like these CAA bonds, these are what Netflix is selling. And ultimately, if you are selling these or you're purchasing these types of bonds, yeah, you're gonna potentially get a lot of money at the end, but that company might not even be there by the time it's time to pay you back. So that's the risk and reward. So ultimately, Standard & Poor, which should sound familiar, we did a stock index discussion with them. Now, they do bond ratings and they rate the stock market with their stock index. And then Moody's also does these bond ratings. And so basically the higher the rating, the more likely the bond will be paid back to you. The lower the rating, the less likely the bond will be paid back to you. But ultimately, when you look at this, usually corporate bonds want to have higher rated bonds, and it's really the health of the actual company itself and the likelihood that this company believes that they can pay it back. So disadvantages, advantages. So once the bond is sold, the coupon rate, well, that bond will not go up. And so basically, if you signed up to get 5% interest, that will not change. That will stay the same the entire time. And basically, when you're getting a bond, you're not buying a part of that company's percentage of that share of that company. You're actually just giving money as a loan, and then they're going to pay you back. A stock is where you own a specific percentage of that different company. Now, to the actual issuer, okay, so why would this may not be good to the actual issuer? Well, the company itself, if Ford Motor Company goes out of business and they gave out a bunch of corporate bonds, well, this is going to take years because they're going to have to declare bankruptcy and it's going to have to paid out through the government. And then also understand that bonds can be downgraded, and so ultimately, if Netflix continues to sell and then they continue to not give people back the money that they loaned them, well, that's going to issue lower rated bonds, and then that's going to impact how people invest within a different company. So putting it all together, I know this was a lot of information. I know that a lot of these terms are a little bit complicated. I really think if you guys do have any questions, you can email me and we could probably get through it that way. We will review short position. We will review P to E ratio. I understand these concepts can get complicated, but at the end of the day, I really want you to consider, what might be some ways that you can invest your own money in the next 5 years. If you're even able to save $50 a month for the next 5 years, that could really be something pretty powerful that you could put into a Roth IRA or something like that. And that's what we'll talk about later. And then one thing to just think about, are you currently invested in stocks? Are you thinking about investing in stocks? What could be some way to do that? And we'll talk about that. And then I really think for both of the groups that would answer this question, those that are currently invested and those that are thinking about it, I think you are really going to enjoy the stock market game that we're going to show. And I think it'll give you a good opportunity with kind of some play money to figure out what you might want to invest in. So let me know if you have any questions. Go ahead and fill out the Google form, and you guys will do great.